But let me ask you something. With earnings per share on a year-on-year basis already down 4% in the first quarter. So with a slowly but surely earnings recession on the door, and your profit margins also compressing in the second half of the year, are you going to be able to have all these people employed, or are you going to be forced to cut some of this long-term workforce, skilled workforce you have? You probably need to cut your core spending at that point. It's just taking a little bit longer, also due to some pandemic distortions, but I think the labor market is weakening, and that is evident. And I think the trend is going to continue in the second half of the year.
We're talking about domestic and global growth with our next guest, Alfonso Peccatiello. He is the founder of the Macro Compass, and once again, he has some very interesting research to show us today. Alfonso, welcome back to the show. Always good to see you. How are you?
Hey, David. I'm doing good, and it's a pleasure to be back here. I see you're doing great, and that's exactly what you deserve.
Thank you. Well, you're doing wonderful yourself. So congratulations on the success of your newsletter. We'll be talking about a few of your recent reports and the research that you've done. Last time we spoke, it was 3 months ago, exactly 3 months ago. Welcome back. Time flies. But you're telling me about how this recession in the U.S. may come as early as this summer. Of course, we know that if we take a look at NBER data, it's always lagging. It's possible we're in a recession now. We just won't know it until they've declared it. So are you still sticking to the timeline that the recession will come as soon as perhaps this summer, or are you delaying it? What's your outlook now?
I mean, of course, the timing has been delayed, and it's hard to say that the recession by June will happen. I mean, of course, most of these data get back revised on the way back, right? I mean, the NBER calls a recession much later than it actually happened. So you might be in one, and the NBER isn't telling you already. I had a look at 4 out of the 7 recessionary indicators the NBER uses, because people need to understand it's not as simple as saying 2 quarters of back-to-back negative GDP growth brings to say we are in a recession.
Proper recession. And in fact, they don't use that. They don't use that measure, actually.
No, indeed. So they actually use 7 different measures. And I think that's a much more comprehensive assessment, because they look at the labor market, they look at the housing market, they look at the services sector, at the consumer spending, et cetera, et cetera. Actually, today, as we speak, David, 4 out of the 7 indicators the NBER uses are actually consistent with the recession today as we speak. But there are 3 that clearly aren't. And those are the labor market and the services sector in particular. So what we see today is quite a weak economy, but the weakness is not broad enough to call it a recession yet. Now, this is leading many people to say, well, if we haven't seen it so far, then probably we won't get it at all. And I don't agree with this statement. I just think it's going to get a little bit delayed, and that the weakness from the manufacturing sector into the services sector is taking a little bit longer to play out. And we can talk about why, but it is going to happen. And one last thing. In 2008, the home builders index in the US rallied 50% 2 times. In 2008, amidst the worst housing recession in modern history, the home builders index managed to rally twice by 50% in the same year. Why am I mentioning that? The stock market isn't the economy, neither on the way down nor on the way up. So people are actually confused, I think, David, because the animal spirits that have been raging in the stock market, take this artificial intelligence mania, or even home builders right now, they have rallied 45% from the lows. Does that mean the housing market is fine? No, that actually means animal spirits are building back in markets, but the stock market is not the economy. And that's something people should always keep in mind.
Let's go over the criteria that the NBER uses for the evaluation of a recession. So on their website, it says real personal income, non-farm payroll employment, real personal consumption expenditures, wholesale retail sales, industrial production. Of those things I just mentioned, which of those components has not deteriorated as quickly as you might have thought that it would?
So those are the components that have to do with consumer spending and employment. Those are the 2 brackets, let's say. They contain 3 sub-indicators. Those are the 2 components of the economy that haven't deteriorated enough to be consistent with the recession. Now, does that mean that the labor market is booming? No. Does that mean that consumer spending is booming? No, but it is not consistent yet with the recession. So on consumer spending, we see mixed data. We see retail sales adjusted for inflation that have been negative for a bunch of quarters in a row. But on the other hand, we still see, employment being relatively okay. We are not having acute layoffs yet. In order to have a recession, you need to have companies laying off people. What's happening in the labor market right now is that you see that continuing claims, jobless claims, are finally heading a little bit higher, but they're not yet consistent with the recessionary levels. Why is it taking so long for the labor market to weaken? I think it's a couple of reasons. The first is, look, if you're a company, this is the cycle you go through. 2021, sales through the roof, revenues through the roof, margins are extremely ample, you make a ton of money. You look to hire people, right, when you're making money. You go and hire people in an extremely tight market. Labor supply isn't there. People have retired out of crypto gains, real estate gains, and so on and so forth. So it's very hard to hire skilled people. You manage to hire them, and then the cycle slows down. And when the cycle slows down, David, in 2022 and early 2023, because it was so hard to hire the skilled people, the first thing you're going to do is not to fire them. The first thing you're going to do is to cut your discretionary spending. You're going to cut your advertising spending. You're going to cut stuff that you can cut, but you would want to preserve this skilled labor, which was so hard to hire in the first place. That's a practice called labor hoarding. Okay, so companies are sticking to their core employees. They don't want to let them go because they experience such a tight labor market to hire them. And that's where we are today. But let me ask you something. With earnings per share on a year-on-year basis already down 4% in the first quarter. So with a slowly but surely earnings recession on the door and your profit margins also compressing in the second half of the year, are you going to be able to have all these people employed, or are you going to be forced to cut some of this long-term workforce, skilled workforce you have? You probably need to cut your core spending at that point. It's just taking a little bit longer, also due to some pandemic distortions. But I think the labor market is weakening, and that is evident. And I think the trend is going to continue in the second half of the year.
This is brought to my attention. If you take a look at the yield curve, so specifically the 10-year minus the 2-year in the U.S., and if you take a look at the last 2 recessions, even the last 3 recessions, the yield curve has always inverted, and then it reverted back to zero. So it climbed back to zero before we officially had the gray bars marked by the NBER as a recession, meaning the yield curve in the last 3 recessions at least has to have recovered before we officially get a recession. Now, the yield curve has been inverted for almost 1 year exactly. I'm not saying it has to go back up to zero before we get a recession. I'm just saying that's a pattern we've noticed. Certainly the bond markets have something to say about this. What do you think?
Yeah, so let's explain how this dynamic works, David. So the yield curve has inverted a year ago, and it has remained inverted for 12 months. And people are very scared of these curve inversions, and they expect that to lead us into a recession. Why is that the case in the first place? So when the yield curve inverts, that's because the Federal Reserve has strict control on the very front end of the bond market. So that's 1 to 2 year interest rates. They control them by simply setting where the Fed funds rate are and telling us where they want Fed funds to be. So if you listen to Powell today, he's telling you Fed funds are at 5, we might want to bring them to 5.5, and we are not going to cut interest rates in 2024. He has a very strong impact on when 2-year treasury yields are trading, basically through Fed funds. But if you look at the back end of the curve, your 10-year interest rate, David, that you mentioned, that part is rather influenced by other factors: demographics, productivity, long-term growth, and inflation prospects. And the reason why the curve inverts is that bond market is telling Powell, yes, dude, you control the front end. You say where 2-year interest rates are, but we expect that tightness in monetary policy you're applying to make a lot of damage to the economy long term. So from year 3, 4, 5, all the way until 10, we expect lower growth and lower inflation, which means that 10-year yields move lower, lower, and lower, and the curve inverts. And people then expect immediately a recession after that. But my research shows that it is really variable. How long does it take between the first inversion and actually a recession occurring? It can take anywhere between 9 months to 24 months before that happens. And it is the steepening, David, after that inversion what you just mentioned. So the inversion from you go to minus 100 basis point between 2-year and 10-year yields. The moment you move back up to zero, that's when a recession is occurring. And the mechanism behind that is that 2-year interest rates at that point are dropping very rapidly. So the tightness in the front end doesn't exist anymore because something has broken. The moment it becomes apparent that something has broken, then 2-year interest rates need to move all the way down and the curve can re-steepen again. Then you are literally in a recession at that point.
The 2-year yield will not move down unless the Fed funds rate will go down, correct? Or can they move independently?
It can when the bond market fights Powell. The moment that Powell is saying, Fed funds 5.5%, I'm not going to cut next year, I'm not going to cut the year after, and the bond market sees that something is happening today, David, then the curve can immediately re-steepen and 2-year interest rates can move down despite Powell trying to verbally talk them up. It's basically the bond market telling Powell, dude, you're wrong, you need to give up. Something is breaking right now. And then 2-year interest rates can move down very quickly.
Well, forget the bond market fighting Powell. A lot of economists are fighting Powell in the sense that they don't agree with the FOMC's latest projections. Actually, you brought this up in a recent newsletter. It's absolutely correct. Astonishing, the FOMC revised up their economic projections from the previous meeting. And so now none of the FOMC members are anticipating economic contraction this year. And in fact, they're revising up their median change in GDP. So previously, their March projection was 0.4%. Now it's 1% by the end of 2023. I wonder what the underlying assumptions are that the Federal Reserve is making for them to conclude that the economy is basically heading towards a soft landing.
Well, as you said, the latest summary of economic projections of the Federal Reserve is a picture-perfect soft landing projection. GDP growth 1%, so below trend, but not recessionary, and core inflation moving down. The underlying assumptions are, David, first and foremost, that the housing market is going to be fine. Residential investment as a percentage of GDP was really negative heading into this year because high mortgage rates had really slowed down housing activity. But as in the first half of this year, actually, we have seen housing kind of stalling, it isn't dropping anymore as hard as many people thought. And that has led the Federal Reserve to believe that the housing market will actually be fine, David. And the moment the housing market is fine, you can also expect construction activity to pick up and also all the GDP activity related to housing picking up again against your previous bleak forecasts. I personally think at this moment, the sentiment around housing is very similar to what we had in 2008 with this 50% plus rallies in home builders I talked about. I mean, everybody seems to assume that all of a sudden the US housing market works completely fine with mortgage rates in the 6.5% area. You just run the math, David, and you can realize that that isn't the case. With the median house price where it is and mortgage rates where they are, it is impossible to sustain a healthy housing market as it was in 2017, 18, 19, and 20 because the mortgage installments are too high. If you ask me how did the housing market manage actually to stabilize in the first half of the year, it's pretty simple. Latest statistics published, I think just today, show that the housing listings in May were the lowest on any single year's May over the last 30 to 40 years. So basically, people aren't selling the house anymore, David. They are simply stuck with their low mortgage rates. They don't want to sell. Selling means buying another house with a new mortgage rate, which is much higher. So they're basically stuck where they are. So they don't sell. And there is obviously a little bit of inelastic demand for housing. I mean, people need to relocate, people die, people have to go to university. So the sticky demand against such a tight supply of housing is making house prices kind of stabilize. But in a market that isn't alive, in a market that is frozen, with mortgage rate at 6.5%, for how long can this fragile equilibrium actually go on? I don't think for too much long.
So how would you evaluate Fed policy in light of their projections? So in your report, you wrote that there's a 58% chance of a hike in July, which is not your base case. Actually, let's look it up. Let's see what it is from the Fed Watch tool from the CME as we're speaking on Monday. Actually, it's gone up 74% chance of one hike by July. You don't agree with that?
No, I still, of course, it's a long shot. I mean, going against a 74% probability price, then it's quite a lot of consensus call. I still think there is a good chance the Fed doesn't hike in July. And why? The thing we didn't talk about so far is also the disinflationary pattern we have been in recently, David. I mean, inflation has been coming down. Also, the inflation component that Powell really cares about, core services X housing. So that's really the subcomponent of core sticky inflation Powell cares about. It's annualizing at 3% now as we speak. The trend in that subcomponent is as low as 3%. So 3% isn't the Fed target, but it isn't anything to be really scared about either, David. So if you look at the data that has been coming in, both on the growth front, with jobless claims trending a bit higher, if you look at the disinflationary trend, which is coming, and most importantly, if you look at the fact that Powell just in May had told us that the Fed wanted to pause to assess incoming macro data before deciding what to do. David, to assess macro data, you need a couple of months minimum, 2 to 3 months, right, to get a bunch of diverse data between labor market, inflation, growth, etc. I think it would make sense for the Federal Reserve to say, we're going to skip as well July. So we have data coming in June, July, and August. And then with 3 months worth of data, we can decide what to do in September. I think that's the obvious thing to do. I don't know whether they will.
A reporter asked Powell a fair question at the last press conference, is that if you're going to signal more hikes, why not just do it now? Rip the Band-Aid off all at once.
That's a super valid question. I mean, I don't know what the Fed is doing. It's a mess in communication. I mean, in May, they told us we're going to take a pause to assess macroeconomic data. All right, then, you need a few months, right, until you're able to make a decision. Then you come in June, you don't hike, but then you say, yeah, but well, we're going to have to hike again a couple of times more. Then why don't you just hike in June? It would make much more sense to say, in May, we thought we needed time. We don't need time anymore because we think the economy is too strong. We're going to hike right now. So I don't know what they're doing. It's a complete mess in communication.
Look, I know you live in Europe, but let's say you live in the U.S. because currently we're talking about the U.S. We'll travel to another country in just a bit. But if you were living in the U.S., what would you want either the Federal Reserve or Congress in terms of fiscal policy to do to make your life better? By your life, I mean to improve your business, to improve your income, to improve your standard of living over the next, I would say, 18 months.
Well, look, David, if you're very cynical, then every business or every private person in the US wants one thing and one thing only, which is lower taxes. And it's very simple. The mathematics is simple. When the government lowers your taxes, you have more money to spend, more money to invest, right? Then obviously that with productivity reforms are exactly what you're looking for. But this is just being very cynical, right? You're just asking the government to give you more money through tax cuts. And I think that's what everybody wants. If instead you take a step back and you look at where the economy is, I think one of the things that is propping up still and making inflation a little bit sticky and making it slower to go down is that fiscal spending has actually been pretty solid on the backdrop of inflation that has been 7 to 8%. In the past, when inflation was that high, David, you had governments cutting on spending very aggressively to make sure that the economy slows down consistent with inflation slowing down. So from a big picture perspective, you don't want inflation to become de-anchored. That's a problem because then all your investment decisions, all your savings decisions, all your borrowing decisions will be very, very volatile because you don't know where inflation is going to settle. So in this historical moment, you would want, from a big picture perspective, the government to scale back on spending. When the government scales back on spending, though, the economy slows down, David. And if you have a business, you don't want that. So which one do you want? The cynical answer or the economist answer?
I just want to make more money. Like what?
Then just ask the U.S. government to cut taxes and you'll be making a ton more money.
Yeah. Then we'll get inflation, right? And then the Fed will tighten rates more. I don't know. I'm just assuming. I don't know if actually, it's a good point. Is there a relationship between taxes and inflation? Have you observed this in your research?
Yes, there is. So people think that the Federal Reserve has the strongest and most immediate impact on inflation, right? So if they hike interest rates, then inflation comes down and vice versa. The reality is that the tightening of the Federal Reserve is supposed to impact inflation via increasing interest rates, making borrowing more expensive. That makes people slow down on spending. Slowly but surely that feeds into inflation, right? And it becomes lower and lower and lower as the economy slows down. That's the mechanism behind
You're
monetary
assuming
policy.
people will spend, right? If I have an extra dollar of disposable income, what's to say I won't put that in the bank? Is that in our culture right now?
I mean, that's a great point. Do you want to know instead one quick way that could immediately make sure that the economy slows down and inflation slows down? If the government increases taxes, because you, David, don't even have that dollar in disposable income anymore. So you don't even have a choice whether to put it in the bank or to spend it. The government just took it. So it's not a popular measure by any means, but government taxation, either increasing or decreasing that, is literally taking money away or giving money to the private sector. And that is a much more rapid and effective tool to slow down the economy or to, fast track the economy. Think of 2021. The government of the United States was sending checks at home to people. It was literally telling them, hey, dude, here is $10,000. You have no liability attached to that. No debt, no mortgage, no nothing. $10,000 out of nowhere. Go and spend it. In 2021, earnings per share year on year in the S&P 500 companies went up by 40% and GDP grew by 5-6%. Easy. People had more money to spend. If you want to reverse that, tax them more, and all of a sudden, people won't be spending.
All right, let's talk about the markets. Good segue. You have a chart. You called it investors protection. Who needs protection? And then you're showing the excess cost of QQQ puts. It's been going down. So yeah, the markets, as this chart reflects and a lot of other charts reflects, has been bullish. Is it for good reason that the markets are feeling bullish right now? Perhaps the markets agree with the Fed that a soft landing is coming.
Yeah, the market has been pricing pretty much a soft landing as the base case scenario. What it's been doing the most, it's actually pricing away the recessionary risks, David. That's what the market has been busy doing. More than being sure about strong growth, etc., it's really sure that the recession won't happen anymore. And so when you don't have that risk in front of you anymore, what do? Why do you own insurance if there is nothing to insure against, right? And that's the chart you just talked about that I showed to my clients. The excess cost of puts on the NASDAQ against the cost of calls is really, really low. So people don't want to pay up for puts. They don't want the protection. Why? Because they think there's not going to be a recession. So why would you want to overpay for puts, for downside protection, if there's not going to be a recession? And I think that is exactly the wrong thing to do right now. People have become frustrated, right, David, by the fact that a recession was supposed to be here already in most of the macro previews that we got at the beginning of the year, but it hasn't realized. So people have been spending these premiums, have been buying these puts, have been staying away from the equity markets, and this catastrophe doesn't realize. So they become very frustrated, and all of a sudden they don't want puts anymore. And I think this is one of the ingredients you actually need to have a recession. You need to have this relaxation. You need to have CFOs and CEOs convinced that it's going to be fine. You lower your defense, you lower your guard, you don't want puts, you don't want protection anymore. And as my mentor used to say, you actually want to buy insurance where insurance is cheap, not when it's expensive. And right now, as that chart shows, insurance is very cheap.
This reminds me of the story Waiting for Godot. Two men are waiting for this other guy, Godot, who never shows up. While they're waiting, they have these interesting discussions. Maybe while we're waiting for this recession, something else productive will come from this waiting, this planning for recession.
Could very well be, but the world is very big, and we talked a lot about the US, but there is a lot happening everywhere else in the world too. Huh?
Yeah. Okay, so let's close off on the US. Investment implications then for the next, I would say, 12 months, given your outlook on the economy and given what investors should do, not what the Federal Reserve necessarily thinks will happen, but what investors should do.
Investors should buy bonds right now. I think we as in bond buyers, people that have treasuries in their portfolios, very soon are going to be dictating to the Federal Reserve what to do next. So instead of Powell leading the bond market to reprice, which was all the way through in 2022, remember when he was telling us, hey guys, the terminal rate is higher. We're going to hike to higher rates, higher rates, higher rates. And then the bond market had to adapt basically to Powell dictating policy and setting the level of bond yields. I think the second half of the year is going to be the exact opposite, David. It's going to be the bond market telling Powell what to do. It's going to be the bond market smelling that something is breaking somewhere. It's hard to say where. It could be another banking crisis. It could be the housing market. It could be China. It could be anything else. But I'm pretty sure that the bond market is going to be dictating to the Federal Reserve that whatever they think, they have to cut rates in 2024. So you want to buy bonds to anticipate this move.
What would change your mind on the base case scenario for a recession at some point? Is there, what would need to happen for growth to pick up again, and the components of recession that the NBER look at to improve?
Yeah, well, look, what has to happen there is that we get a big stimulus somewhere meaningful in the world. And that's not going to be the US from a fiscal perspective next year, hardly going to be from a monetary perspective next year. It might be China. So if China shows up with something big, David, and then their economy really restarts their engine again, then you're adding another layer of growth to the global economies. Then you might be able to actually avoid a recession. So a lot of my outlook actually here relies on what China will be doing, because I think the US is pretty much painted in a corner. Same for Europe. It's very hard to come up with any stimulus when you are looking to tighten policy, both fiscal and monetary, to fight inflation. China, a different story, but I don't think they will be successful with any stimulus over there.
China's growth, let's talk about China now. Their growth was below consensus estimates, I think, in May, actually contracted. And now there's talk of stimulus. So what kind of stimulus are we talking about?
So on China, we need to take a step back, David, and explain how we got here. The way China stimulated growth between 2000 and 2020 was one way and one way only: leverage, credit, and debt. This is how China actually grew. So Chinese private sector and public sector debt to GDP summed together, so the debt of the state-owned enterprises, the corporates, the households, and the various states and local governments in China, rose from 100% of GDP in 1998 to 300% in only 20 years. So China levered up as aggressively as they could. The more credit, the more debt was in the economy, the more people could spend money, and the economy grew more rapidly than the structural growth of China would otherwise allow. Now comes 2021, and Xi Jinping decides to actually clamp down on the tech sector and on the real estate market. Because at some point, the real estate market in China was worth as much as $50 trillion. That's much more than the US equity market, to give you a reference.
Is that number counting the ghost apartments that no one lived in?
Yes. Yeah, okay. you correct. But this is how China propped up their GDP, David, by having this construction spending, which is accounted in the GDP, right? And the real estate market went to be valued as much as $50 trillion. At some point, Xi Jinping thought, well, that's a bit too much. We should maybe calm down animal spirits, and wanted to engineer a soft deleveraging. There is no soft deleveraging of a $50 trillion market, David. So the moment he went there and he clamped down on the tech sector and on the housing sector, we had a big deleveraging and people were hit. I mean, Chinese consumers, they can't make money on their salary. Wage growth in China is pretty small. Consumption as percentage of GDP is very, very small in China. China is in a credit investment-led economy, not a consumption-led economy. As a Chinese consumer, the way you could try and make money is by participating in this bubble, by buying houses, right? By levering up and buying houses and making money in the real estate market. The moment Xi Jinping says, this is over, you get hit very hard. And that's exactly what happened. So the economy slows down dramatically. They reopen, comes this reopening euphoria. They need stimulus, right? They need stimulus to reopen and to grow again. So what are they going to try and do? Exactly the same, credit. They go and they say, hey, banks, you need to lower rates, you need to give more credit to people, they need to get more credit on, they need to spend more. But households don't want credit. They have been slaughtered over the last 2 years exactly with credit, right? They've basically been deleveraging. This is exactly like in Japan in the 1990s, where the real estate bubble in Japan led the Imperial Palace of Tokyo in 1989 to be valued more than the entire state of California. I think about that, it's ridiculous.
California
But
was very
that's
cheap back then. Eh?
no, I think the Imperial Palace of Tokyo was
Okay.
way too expensive.
All right.
But there was this leverage effect. And then all of a sudden, the bubble burst in the Japanese housing market. And Japan tried to stimulate in the 90s, but never managed to get back on its feet because households were hurt so bad. They didn't want to hear the word credit or leverage. And I think that's what China's going through. So I don't know what are they going to announce, but if it's the same good old soup of credit, it isn't working, David, because the deleveraging has been pretty profound and bad. And you're seeing the result now with weak consumer spending, weak retail sales, weak GDP growth.
Well, I wonder how much of this negative growth that was reported last month was simply due to the lockdown measures they imposed. Remember, it was the economy was closed for a long time. Recently, it reopened. So all they have to do is reopen the economy. You don't need
they did.
Stimulus. But yeah.
They did. If you look at the some timely indicator of mainland flights in China or subway usage in China, for example, it gives you an idea whether the economy is really functioning somehow similarly to prior to the pandemic. And it is. It is functioning at roughly 70 to 80% internally in terms of, freedom of movement of people within China. Nevertheless, people don't want to spend money, David, because they've been slaughtered from house prices decline and tech stocks decline over the last 2 years to the point this revenge spending we had in the Eurozone and in the US, it is not happening. And Chinese stimulus is ineffective because it asks people to lever up more after having been slaughtered by the very same leverage over the last 2 years.
So for investors who aren't directly participating in the Chinese markets, I guess the question is, what is the implication of this conversation on the rest of the global economy?
So we're looking at the Chinese yuan, which is dropping every week in, week out. So we have the Chinese renminbi settling now at 7.25 against the dollar. So it has breached the psychological level of 7 against the dollar, and it keeps weakening. So if credit isn't working, if the stimulus isn't working, David, what's the way out for China? They have two options. The first is a Chinese renminbi devaluation. So you take your currency and you devalue it aggressively. You remember they did that in 2015. Okay, and that surprised the market. That was a shock for markets, right? China decides to devalue their currency. Remember, it's an export-led economy. So when you make your currency very cheap, all of a sudden the goods you're selling abroad become very attractive, right? Because your currency is worth much less. So for the US to buy Chinese products, it becomes extremely cheap. So they hope that they can get more buyers from abroad by weakening their currency. But weakening your currency is also a very risky strategy, right? Because it could lead to inflation. And I don't think China is ready really to weaken their currency.
We have to give some context here. So the Chinese yuan operates on a managed float relative to the dollar. So when you say devaluation, it's still within a band, correct?
Yes, right now it is. It is slowly but surely devaluating, right? So you have the Chinese authorities which are allowing the Chinese yuan to settle within this band, but at lower and lower levels against the dollar. That's what's happening. A hard devaluation instead, it's what they did in 2015 when they came up and they said, we're not going to allow a small percentage decline today. We're going to settle the yuan at much, much weaker levels against the dollar. All of a sudden, it's a shock policy, basically. That has a lot of risks, though, because don't forget, you make Chinese exports much more attractive by making your currency weaker, right? That helps with export growth. But don't forget, China is also a big importer of oil. So China needs to pay for crude oil using its domestic currency, and they need crude oil for their economy to keep marching, right? So when you devalue your currency, you make your imports much more expensive too. And the price of crude oil in renminbi today is 60% higher than it was when they decided to devalue back in 2015. So it's a very risky strategy today for China. I don't think they're there to pursue it. So honestly, I don't see for them a way to get out of it. And I see a lot of market enthusiasm still that China can announce a magic policy that is going to restore growth. In a balance sheet recession, there's not much you can do.
I remember 20 years ago when China was still predominantly an export-driven economy and manufactured most of our goods, they were dependent on growth in the U.S. and Europe and abroad for their growth.
Yeah.
Can you say the reverse now? They're starting to shift away from the export economy, manufacturing economy.
They've tried to shift away, but still they haven't managed to do that. If you look at the consumption share of GDP, so how much of your GDP is not export driven, not investment driven, but it's consumption driven. Okay. If you look at the US, that's like over 70%, maybe 80%. If you look at China, that's still 30%, David. They haven't managed to get the engine of Chinese growth to be the Chinese consumer. Chinese consumer still accounts for a very, very small percentage of Chinese GDP growth. They're still relying on investment, on credit, on exports. And those are the stimulus packages they're trying to design by making export cheaper, stealth devaluation that we're seeing. By throwing credit at the economy, hopefully they can generate some investments out of it. But it isn't working for two reasons. First, the global manufacturing cycle is really weak. Look at these manufacturing PMIs. Look at Germany. Germany's in a technical recession already. All the manufacturing-driven cycle, even in the US, is extremely weak. So you can make your exports cheaper by lowering your renminbi, by weakening your currency. But if the global demand for manufactured goods isn't there, what are you going to achieve? Not much, right? And then the second reason is the investment-led, the credit-led stimulus, as we discussed, doesn't work. If you have deleveraged before, you have hit people to the point they don't want to participate in another mortgage binge because they've been hit over the last 2 years by declining house prices. There is nothing in the good old toolkit of China that has worked for the last 20 years that in this particular occasion can work again. So I don't think China is really well positioned to generate growth going forward.
So you don't think this new stimulus will positively impact the U.S. economy in some indirect way?
Not. No, it will not. I think the market might get excited at first. We have seen it already a couple of times, right? They come with some headlines. Hey, China is planning big stimulus. They don't even tell us exactly what they're planning, but the market is it has so much muscle memory. When they hear stimulus, they just rally, right? But then a week later, they come back, right? And you see all this currency like the Australian dollar, the New Zealand dollar, the Chinese renminbi, everything linked to China that shows weakness. And I think this trend will continue.
Look, the Chinese real estate story for the wealthy investor in China, that's not an issue. If they can't invest in China, they can just invest in Vancouver where I live. So I'm not worried about that for them. But no. I am worried about their long-term growth. Like you mentioned to me offline about some stats, particularly with their population growth and their demographics. Tell us about long-term growth in China.
So look, David, that's really a bad story if you ask me, because, long-term economic growth of a country is really determined by population growth, by healthy demographics and good productivity trends. And look, China is at their labor force growth being on one trend up, very, very rapid trend up between the 1980s and the 2020s. So the labor force in China has grown to be as big as almost 1 trillion workers. 1 billion, sorry, trillion is too much. 1 billion workers.
Okay.
Sorry, trillion is too much. 1 billion workers. Still, that's a ton of workforce, which has also helped the globalization efforts, right? This is cheap labor. Cheap labor in China has made so that US and Europe outsourced manufactured good production basically to China because it was very cheap to get the same goods produced there by an increasing amount of people. But now, over the next 20 years, the Chinese workforce will shrink by 250 million workers. So how can you grow an economy still at what they plan to be 4 or 5% GDP growth rates, assuming you trust these Chinese growth rates? How can you produce the same amount of growth over the next 20 years with 25% less people working? That's not going to happen, David. That's not going to happen.
The individual productivity just has to be above 25% increase.
It's massive. I mean, we need some artificial intelligence miracle here that is able to permeate any sector of society. Honestly, if you make a rational assessment, Chinese growth is going to come tumbling down very rapidly over the next 20 years. They have a mountain of debt. They can always try and produce more. Don't forget, it's a centrally planned economy as we speak, so they can try to slosh more credit through the economy. But we are already seeing preliminary signals that consumers don't want more debt on their shoulders, David. They have some trouble accepting that model going forward. I really don't see a good outcome for China over the next 10 to 20 years.
So two follow-up questions. The first is, does slower growth necessarily mean lower living standards?
No, that's a very valid question. What Xi Jinping is trying to do is to shift the prosperity paradigm from an investment-led, export-led economy to a consumption-led economy, right? He wants Chinese living standards to improve. But that isn't an easy thing to maneuver around, right? One of the key successes of China has been to have cheap labor so that everybody outsource their production in China. That's basically what happened over the last 20 years. The moment you make that labor not cheap anymore, there's not going to be a lot of people that will volunteer to shift their factory in China, also because of geopolitical risks. They will rather look at Vietnam or Malaysia or Indonesia or other more friendly, let's say, offshoring. So China is really in a hard position. They are trying to do that shift, but it is very hard to sell as well to the West that they're trying to do that shift. So I don't think they will be very successful. They are trying, though, for sure.
What does lower growth mean for commodity prices?
It doesn't look good, to be honest. I mean, the thing about commodities is, luckily for commodity prices, China is not the only driver. I mean, if the Chinese structural demand for commodities goes down because there are less people, there is less growth in China, but everybody else is trying to electrify, is trying to move to a green transition, then the loss of demand from China can be more than offset by additional demand for green commodities like copper, aluminum, lithium, etc., from all the other side of the world, right? So the picture is more balanced, I think, long-term for commodities than people make it so only looking at China. You need to look at the entire world, and there are certain commodities that today are pretty scarce in supply if you look at the demand that we'll have to generate to get to that net zero transition. So I think it's a bit more balanced for commodities than people want to make it look like.
All right. Well, the macro compass will answer a lot more questions, but we're running out of time today. Everyone should check out the Macro Compass newsletter. If you were to research a major investment theme, either medium term or long term, that everyone needs to be aware of, besides what you've already written, what would that theme be?
The shift of demographics in voters in the United States, in Canada, in Europe, and everywhere else. So I've done some preliminary research, David, and by 2032, for sure, most of the voters in the US will not be Gen X, boomers, etc., but instead will be mostly young people that haven't benefited from the trends of the last 20 years of asset prices and house prices going through the roof. What I call the asset-less people. Those are people that will want from politicians something different. They don't want the status quo. They want to close this wealth gap between, the older generations and them. So what are they going to demand? Are they going to demand more QE? I don't think so. I think they're going to be demanding something different. They're going to be demanding labor over capital. They're going to be demanding fiscal deficits over austerity. So it can be a very, very big paradigm shift in politics, I think.
Okay. And you've started this research, you said?
Yes, pretty much.
You're working on. Yeah, you're working on right now. Tell us some other things you're working on right now, and where we can go to learn about this research.
I would say, David, the other thing that people need to be aware of is that the next 10 years in macro and markets are going to be really different than the past 20 years. And people are very, I think, numb to the idea that just buying and holding some stocks and some bonds is all you need to do and you're going to be fine. That works if the volatility around inflation and growth is very, very low. So the cycle is very predictable. Nothing happens. Central banks have your back. I think over the next 10 years, there are a lot of reasons why to believe inflation will be much more volatile. You'll have periods of high inflation. You'll have deflation. You'll have growth. You'll have recessions. And if you have all that volatility, your portfolios need to be much more nimble. You need to do macro. You need to study and understand the cycle much better. So I think that's an important thing for people to understand. I try to do my best and break down macro and market developments jargon-free, plain English, in a way that people can understand it, and also give them actionable portfolios and trade ideas. All of that, it's on themacrocompass.com.
All right. So the macrocompass.com, you also have Twitter at macroelf. Are we missing anything?
Yeah. So Twitter at macroelf, you'll see some snippets of macro there, much less than what I do for clients, of course, on the macrocompass.com. Occasionally a couple of pictures of the Amalfi Coast and pizza, because I'm Southern Italian after all.
Do you ever consider translating your service to Italian? Just double your audience.
Actually, that's a great idea. Maybe I should do that.
Yeah.
Yeah. Thanks for the advice, David.
It would be easy for you. You know, you just...
Pretty much. My Italian is much better than my English, I promise that.
Well, your English is already very good. Plain English from an Italian, so I encourage everyone to check that out. The Macro Compass. Thank you very much, Alfonso, for your time today. Appreciate it. Speak to you again soon.
Thanks, David.
Thank you. Don't forget to subscribe.